Welcome to today's Canary report. Markets are rallying with conviction as investors absorb the shock of a US-Iran peace agreement that sent oil and bond yields tumbling, while tech optimism keeps the momentum rolling. Let's see what our canaries are telling us about whether this is sustainable or just relief trading. Speculators are stepping back in with enthusiasm. ARKK led all spec leaders today at plus 5.07%, followed by SPHB 2.93, MAGS 257, and XBI 194. The Iran deal's de-escalation of geopolitical risk premium has created room for speculative capital to rotate back in, particularly into growth-oriented vehicles that had been under pressure. This isn't a flight to safety play. It's a genuine repricing of the risk landscape. When UVXY drops 10% intraday while ARKK climbs 5%, you know investors are comfortable holding longer duration exposure again. The peace agreement removed one major uncertainty, allowing speculative capital to redeploy into higher beta names that had been sidelined by geopolitical volatility. Credit conditions show early signs of relief. The Iran deal sent yields lower across the curve, with high up plus 0.69% and HYGW notably stronger at plus 1.26%. The yield compression helped marginal credit temporarily, but we're seeing a mixed picture that suggests investors are cautious about assuming the worst is over. HYG remains essentially flat, while longer duration HYGW responds more aggressively to the geopolitical de-escalation. This selective response tells us institutional money is still sizing up exposure, rather than committing fully. There's room for volatility if the agreement faces implementation challenges. Credit markets are digesting a major risk event, and today's data suggests relief that may be temporary unless supported by broader fundamentals. Fear evaporated spectacularly this session. UVXY crushed it with a 10.24% drop, while VIXY 6.87 pills and VXX 6.58 followed closely behind. The VIX itself dropped 8.37% to 16.2, one of the steepest intraday declines we've seen in months. This isn't just a technical correction, it's a fundamental repricing after geopolitical tensions spiked earlier this week. When fear volatiles drop double digits while major indices surge, you're seeing capital rotation out of defensive hedges into productive assets. The Iran deal removed an overhang that had been pricing in prolonged uncertainty. Investors are recalibrating their risk models, and the fear gauge is flashing clear. Geopolitical risk has de-escalated materially for now. The real economy is humming. SMH led all sectors at 3.98%. Carrying semiconductor momentum into traditional manufacturing plays like IYT 0.95. Industrial stocks are benefiting from both the oil price drop and broader market strength, while RSP's modest 0.47% gain shows small-cap exposure is participating in the rally. KRE's 1.69% decline tells us regional banks remain sensitive to interest rate implications of the yield compression. The semiconductor sector's outperformance isn't surprising given SPCX IPO flows and continued AI infrastructure demand. But what stands out is how evenly distributed gains are across traditional industrial plays, rather than just tech. This suggests underlying economic fundamentals are holding up well enough for capital allocation to move beyond defensive positioning into productive assets. Safety assets showed selective strength. GLD popped plus 2.41% as gold's safe haven appeal persisted even with the peace deal, while bond and TLT remained essentially flat. This isn't a massive rotation, it's measured recalibration. When oil drops 50+ basis points in yield compression, but gold still climbs, you're seeing investors hedge against implementation risk, rather than assuming all downside is priced out. XLP's 0.34% decline shows consumer staples aren't commanding premium valuations anymore. The safety trade isn't dead. It's evolved into a tactical overlay position as geopolitical certainty returns. Gold's performance relative to bonds suggests investors still want some duration protection, but they're no longer pricing in prolonged chaos scenarios that would have driven larger rotations earlier in the week. The Iran peace agreement is the dominant force today. Oil and bond yields dropped sharply, fear volatiles evaporated, and speculative capital flowed back into growth names. But this isn't a simple all-clear signal. We're seeing selective repricing across sectors, with tech leading, industrials participating, and safety assets maintaining tactical overlays rather than full defensive positioning. The VIX compression combined with spec leader strength suggests investors believe the geopolitical risk premium has been materially reduced for now. That said, credit markets' mixed response and KRE's underperformance remind us that implementation uncertainty remains. A peace deal without sustained economic fundamentals is just a temporary reprieve. That's your Canary report for today. The market is pricing in relief from the Iran deal while maintaining tactical prudence across sectors. Stay alert for how credit markets evolve as implementation details emerge, and we'll see you tomorrow.